Welcome to Bloomberg Markets. I'm Katie Greifeld. Taking a look at the S&P 500 right now, higher in the session as we start to hear from Fed officials on what their next move might be. A lot of concern about the labor market is what we've heard so far, but stocks seem to like it. You take a look at the S&P 500 right now, currently up about 0.2%. We're coming off of 2 straight weeks of gains, but that momentum continuing to build. Same thing, too, if you take a look at big tech. Your NASDAQ 100 currently up about 0.2%. Some interesting movement if you train your eyes on the bond market. We had yields going higher earlier, but now lower right now. You can see the 2-year yield currently down about 2 basis points, a little bit, I'm going to call that unchanged on the 10-year right now. Of course, we had been higher to the tune of about 5 basis points, but now a little bit of a bid coming back into the bond market. But for some midday movers on the equity side, let's bring in Bloomberg Markets correspondent Abigail Doolittle.
And we're going to start in Europe, funny enough, Katie, but we have big movers for some of the European banks, especially Commerzbank and UniCredit. And this, of course, on the ongoing news around the idea that Commerzbank is really opposing the UniCredit action to potentially boost its stake to 21%, which would make its stake in Commerzbank larger than the German government's and also set up the possibility of a takeover. So Commerzbank down 4.3%, and then you can see UniCredit also down the same amount. Interestingly, the U.S. banks down. It's not clear if this weight is a piece of that action, but certainly some tensions here for some of these European banks, and especially as, again, the German government is really saying that they do not want UniCredit to have that larger stake. We have to the upside, though, Intel up 2.8%, and this as Apollo is saying that they could invest up to $5 billion in the chip maker. It's not sure. We're not sure if that will happen. Intel saying they're considering the plan, and of course, this follows last week's Qualcomm saying that they may consider some sort of a friendly takeover. And then finally, the big mover on the day, both from a percentage standpoint and a point boost to the S&P 500, Tesla up 4%. It's interesting. This move comes as we do have Barclays saying that deliveries for the third quarter coming in a little bit above what the street's expecting at 470,000 vehicles delivered as opposed to 460,000. That seems like a small piece of news for this stock to be going up so much, but that is what's happening, Katie, or maybe folks just continuing to buy that dip.
Yeah, shares just about even on the year when it comes to Tesla, of course, recovering mightily from that drawdown earlier. Abigail Doolittle, thank you so much. Now, as we mentioned, as the Fed has begun its rate cutting cycle, debate is picking up over the size of the Fed's next anticipated move. Atlanta Fed President Raphael Bostic made remarks earlier on where he thinks we should go from here.
Momentous as the recent decision to begin removing restriction from monetary policy was, taking that step does not lock us in a cadence for further moves. I think it's important that no one think that we're in a mad dash to get to some neutral level. Given the amount of uncertainty in the economy, being more patient will be valuable.
And for more on what the markets are pricing in for the rest of the year, we're joined now by Callie Cox. She is Chief Market Strategist over at Ritholtz Wealth Management. So we heard from Raphael Bostic there. We also heard from Neil Kashkari earlier in the day saying that he backed that Fed rate cut that we saw last week, that big rate cut, and basically saying that the balance of risks has shifted away from higher inflation to the risk of further weakening of the labor market. You add it all together, what is it? Where does that leave markets in the midst of this bull rally when you think about that concern shifting to the labor market?
I definitely think the risk of sitting out this market is still bigger than the risk of buying at peaks, Katie. For the Fed speak, I mean, we're going to get a lot of that this week and over the next few weeks. And we might be stuck in this 50 basis points versus 25 basis points cut environment. But, you know, we're telling clients that that's not the takeaway you need to have in this market. The economy is still quite solid. The labor market, you know, is stalled at the moment, but we're not seeing unemployment surge. You know, the Fed is lowering rates. They seem to be at the curve, or at least, you know, looking at what's important here. So, you know, I think we have a setup for, you know, more gains into year end and certainly into next year.
Well, let's talk about the composition of those gains. There's a really interesting piece out on the Bloomberg terminal written by our Bloomberg News colleagues, basically saying that you think about the playbook for past rate cutting cycles, that maybe it doesn't apply here. You think about the Fed cutting into growth rather than into a weakening economy. Maybe the old playbook of just buying utilities and some of those defensive names doesn't apply. When you think about what's going to power this rally through to year end, who do you think is actually going to demonstrate leadership in this market?
Well, I think that's a good observation, and it's hard to look at historical analogies for this cycle. I mean, I love looking at market history, but even I get tripped up at the fact that the Fed is cutting into growth. But we've also seen a really weird bull market that started during a Fed rate hiking cycle, which is exceedingly rare. So, Katie, we're looking at small caps. We're looking at smaller and mid-sized companies as we head into the end of the year, especially as the economy stays solid. We think that these could be good long-term plays. And I mean, you just talked about defensive parts of the market. They're also rate-sensitive sectors of the market. A lot of those stocks are considered defensive because they pay out a dividend. They are a little more stable. They are showing value in this environment. So, I don't think it's necessarily wrong to look at defensive stocks, but I wouldn't lean too far into defensive strategies.
Well, let's talk about the spiritual opposite. Let's talk about cyclicals. Let's talk about big tech. What's your outlook there? I mean, big tech, it's already done so much work this year, even with that, hiccup that we saw in the summer, that weakness we saw after the latest round of earnings. But can big tech sustain the rally here? Can it sustain and build on that momentum that it's already seen through the majority of 2024?
Well, I think tech has become a victim of its own success. I mean, tech, of course, has compelling stories. I think AI is a very compelling story. But at this moment, with valuations so high and with rates likely not coming down as quickly as the market expects, then, I probably take a little bit of money off the table there and look at the more cyclical sectors, especially the rate sensitive areas of the economy. Real estates, potentially financials if consumer spending stays strong, and then dividend stocks, and that brings you to those more defensive sectors. But again, staying exposed to the market is the most important thing here.
Well, I like that thinking that, maybe tech here, a victim of its own success. You think about the comps that some of those companies are going to have to compete against, and it's a tall order, but we have to talk about AI. And I want to hear your thoughts on how much attention you have to pay to AI, because you think about typically defensive sectors such as utilities. You can make an argument that a lot of the gains that utility stocks have made this year come back to AI and basically the linkages there. I mean, both to the upside and to the downside when it comes to disappointments. How much does AI factor in?
We serve long-term clients at Ritholtz. So what we tell them is that AI is a longer-term story. There's no doubt about that. If you're an investor and you're, trying to play AI over the next month or two, I'm just going to tell you that it's really hard to trade a long-term narrative. And with tech where it's trading right now, I mean, a lot of the names that, AI investors have looked toward are those big tech names. So at this moment, AI might not be the most compelling narrative over the next 3 months, but with what we've seen in terms of R&D spend, in terms of, advancement within the space, in terms of productivity gains that we could see in the economy, we still think AI is quite compelling. But at the moment, we would call back our tech holdings just to position ourselves correctly going into the end of the year.
So AI, it's an investment. It's not a trade. Let's bring that conversation, that logic over to politics. Of course, we're 6 weeks away from the U.S. presidential election. And we talk about the Trump trade. We talk about the Harris trade. But I want to know how you're approaching, of course, this presidential election, a change in administration from the perspective of a long-term investor right now, Callie.
Well, I like what you said, Katie. It's an investment, not a trade, right? I mean, first of all, politics don't matter for the majority of investors out there, at least on the investment side. I mean, thinking that one person can control the entire economy or the stock market is pretty ludicrous. So, we remind clients of that. But we also tell them that there's going to be a lot of volatility around the election. And we've seen quite a bit of it recently because there are a lot of headlines. This is an emotionally charged event. We've seen that in the past 4 or 5 election cycles. And I'll add too, I mean, there are ways to position around certain potential policy changes. But for the most part, if you're a long-term investor invested in index funds, you just need to ride the wave into the election and digest the policy changes that could come afterward.
All right, ride the wave. It's a good place to end it. Callie, always great to speak with you. Really appreciate your time. That is Callie Cox. She is of Ritholtz Wealth Management. Now, coming up, the largest U.S. nuclear reactor operator is reviving 3 Mile Island nuclear plant in Pennsylvania. Wall Street reacting with optimism. We'll speak with Joe Dominguez. He is the CEO of Constellation Energy. Next. This is Bloomberg. This is Bloomberg Markets. I'm Katie Greifeld. It's time now for our stock of the hour, and Constellation Energy has been hitting highs after announcing it would invest $1.6 billion to bring the 3 Mile Island nuclear reactor in Pennsylvania back online. Microsoft will purchase the energy for 2 decades. And this, of course, is the latest sign of surging interest in the nuclear industry as power demand for AI soars. Joining us now, I'm pleased to say we have Joe Dominguez. He is the CEO of Constellation Energy, joining me on set. It's great to see you.
Great to see you. Thanks for having me on.
So let's talk about the tick-tock of this deal. Of course, Microsoft agreeing to buy 2 decades worth of energy. When you come at it from the investor perspective, it feels like investors have just been waiting for a catalyst for nuclear. So with that perspective in mind, I'm curious how long this deal had been in the works.
Oh, God. We started thinking about 20 months ago that the right thing was to figure out a way to restart the machine. So from an inside Constellation discussions with our board, the conversation started 20 months ago. But for a long period of time, it was just, how do we do it? Can we do it? What are the critical pieces of equipment we'd have to buy in advance? So we got that done. And then earlier this year, we started talking to Microsoft about it. We had partnered with Microsoft on different products before, so they made sense as a client. And of course, they have the need.
So the relationship was there, and of course, we see the culmination of that now. I'm curious, I mean, when it comes to the nuclear industry, you have bipartisan support. You read a lot of academics and, other thought pieces that nuclear just makes so much sense, but there's still that reputation cloud, if you want to call it, hanging over it. I'm curious, when you think about the industry now versus when you were spun out of Exelon in 2022, how has it changed?
Oh, God, it feels like 10 years, right? It's really 31 months that we have been, and back then the thought was, there wasn't going to be a catalyst. It's always one of these things where, in retrospect, you think the pieces are coming together. Electrification of the transportation sector, home heating, industry. We're onshoring a lot of industry now to deal with supply chain issues. But AI was the thing that just really drove the load projections to a point where you said, without nuclear, it's not going to happen.
Did that surprise you, the fact that you did have AI come along and be such a theme? I mean, it feels like it's almost in every part of conversation that you could have right now, and you've seen power demand tick up as a result. Did that surprise you?
Well, that it was AI, of course, because I wasn't focused on that. But that nuclear was going to be important, it was absolutely clear to me for a long time, and I spoke about this for a long time, that if we're going to run a full-time economy on emissions-free energy, we couldn't just run it on part-time power. We had to have resources that we could dispatch and would run all the time, especially as we transitioned away from fossil fuels. So the fact that nuclear was going to be relevant and important again, that was no news to me or anybody else in the industry, especially folks who had grown up planning the business. But the catalysts and when they would happen, that was a surprise. I knew nothing about it, really, just to be honest.
Yeah. Well, let's talk about the balancing act here, because, of course, AI, tech companies, they get a lot of the headlines when it comes to power demand. But how do you plan to balance out their needs with the needs of regular customers and industrial demand, for example?
Well, the markets in which we operate are so-called competitive markets. So we don't have a regulator that says, well, we're going to build, these 5 power plants. We use price signals in our market to drive investment, much like you would for wheat farming or natural gas or oil or any other commodity. So as prices increase and supply-demand tightens, we would expect people to come in. And that's what's happened over the last 20 years. In our markets, people have put private capital to work building power plants when needed, and I expect that will happen again here.
And of course, we're about 6 weeks away from a presidential election. And, you know, we already said this, but you think about nuclear, it has support from the right and the left. But even that being said, I mean, how do you anticipate a change in administration potentially affecting your business? Are you planning for that?
Well, you have to be cognizant of it. But in our business, if you're going to change the strategy every time there's a new occupant in the White House, or every time something changes in Congress in terms of which party is in control, you're going to do nothing. You're going to be so constipated that your strategy is never going to work. So for us, we look at the long-term needs of America. Here's what's clear to me. AI is here to stay, and the country has to be successful in AI from a geopolitical security perspective as well as an economic perspective. Number two, the climate crisis, although we may change our focus over a period of time, is going to be something that we are going to have to deal with as humanity. So I think about our assets and our strategy around those two pillars and drivers, and the third thing being reliability and affordability. So that's what we're working to solve, and we can't redesign it every 4 years.
So I want to bring this conversation to your share price. You and I were speaking beforehand, before the segment started, about how I often ask CEOs about their share price, and they say, I don't monitor it. But your shares have doubled over the past year. So theoretically, you have plenty of money to spend here, a lot of cash on hand. How might you plan to spend it?
Well, look, we think the best investment we can make is in Constellation. So when we don't see a growth opportunity, like the growth opportunity we have here with Microsoft, we have and will continue to invest in Constellation through share buybacks. I will say this, because I do watch your show, and I have seen CEOs say they don't watch their stock price, and I wonder if their board really buys into that. But look, again, I mean, it's like the politics question. It's a thing you have to be cognizant of, and when you have big moves, you're always watching it. You probably endure the pain of the downs more than the joy of the ups, to be quite honest. But you have to have a long-term durable strategy. So I keep a pretty good eye on it.
Yeah, I mean, if I had a real-time report card telling me how I was doing, it's the only thing I would look at. But in any case, shifting away from just nuclear, I am curious what's going on with your hydrogen program in specifics.
Well, we're looking for final regulations out of Treasury. And at this point, I'm anticipating we'll see those final regulations after the election, given everything that's on Treasury's plate in terms of IRA rules. So we're at a stalemate right now. Right now, the Treasury rules do not permit existing nuclear to participate in making hydrogen. We think that's a mistake. We think that's contrary to the law. And we've been quite outspoken about this. I think we've advanced a very good case to explain why Treasury should change its thinking in the final regulations, and I'm cautiously optimistic they'll do that. Then we'll really get into it, because here's the important thing. While we want to transition away from fossil fuels, keep in mind that roughly 83% of industry is still relying on fossil fuels for their processes. It's only 17% electrified. And we're going to need replacement drop-in fuels like hydrogen to replace some of fossil fuels in those operations.
And we don't have much time left, but I have to ask, I mean, the human element of what we're talking about, reopening the Mile Island nuclear reactor. I mean, a lot of people, their first thought was, okay, I'm thinking about that partial meltdown that we saw in 1979. I mean, how do you answer those fears? You have all the great benefits of nuclear, but still there is that human emotion element there.
Oh, sure. Look, you got to remember, that was the worst black eye we ever had as an industry. But it was something else for us that we were inside of it. It also began this conversation about how do we get better all of the time? And the thousands of process improvements and equipment improvements, construction improvements, all began much like in our personal lives, where you have a hiccup or a bad thing happens, you learn and grow from it. To us in the industry, that was the rebirth. That was the beginning of figuring out how to do it better. And I'm proud that the World Health Organization scores nuclear as the safest technology, tied with solar. In fact, a lot of people don't talk about this, but in the 50-plus years since Eisenhower's famous speech, more people have been killed falling off rooftops installing solar panels than have ever been injured in industrial accidents at nuclear plants. So it is a good safety record, but we understand the critical importance of this compact, we have communities, and safety will always be number one for us.
All right, well, that is a good place to leave it. Really appreciate you taking the time. That, of course, is Joe Dominguez. He is the CEO of Constellation Energy. This is Bloomberg. All right, back to our top company story of the day. Intel potentially being approached with another potential deal. This one would be a multi-billion-dollar investment from Apollo. For more on this, let's bring in Bloomberg Technology co-host Ed Ludlow. Intel shares currently up by more than 3%. A great week yesterday, of course. There was a lot of speculation about Qualcomm and now Apollo. What do these companies see in a potential investment in Intel?
Well, Intel needs cash. Right, it has a plan, and that plan orients it towards foundry, the business of manufacturing semiconductors, but it's capital intensive. They have history with Apollo, so it's logical. Qualcomm was a surprise. You have to ask what kind of a role the bankers on all sides are playing here.
And it's interesting. I mean, like you said, Intel needs cash. Just how badly do they need cash? If we don't see Qualcomm or Apollo or someone else step up, I mean, what would that potentially mean for this company?
So Intel designs chips and it makes chips. The design side is 70% of revenue. So they've scaled back because it's on the foundry manufacturing side where the losses are, but they still have to grow it. You need scale. And their aim is to win third-party customers. So they have to be selective in where they build new factories, how they handle capacity for clients at the same time as building their own chips. And I think these two stories kind of are competing one against the other to answer how they move forward in that respect.
All right, Ed Ludlow, great stuff. I know you've been all over this, but that does it for Bloomberg Markets for now. Of course, I'm Katie Greifeld, and this is Bloomberg.